I'm Rick Kaler. Thanks for joining me. The simple and easy online payment apps like Venmo, Zelle, PayPal, Google Pay, and Apple Pay could be in for a complex transformation if the IRS has its way. Congress recently appropriated enough money in the American Rescue Plan to let the IRS hire 87,000 new agents. The goal was to help the service collect billions of dollars in taxes owed by individuals and companies who are evading their legal tax responsibilities. One way that some people evade paying taxes on income is through the use of what's called third-party payment apps. Until now, these apps have not been required to report an individual's transactions to the IRS if they have the fewer than 200 transactions or a total dollar amount of $20,000. The lack of reporting makes this income effectively like receiving cash. Now, while the law requires that all individuals report and pay taxes on any payments for goods or services, it's really hard to track income that comes in the form of cash or online apps. So in an effort to eliminate hiding income on these apps, the IRS has now lowered the reporting requirements to one transaction or a total dollar amount of $600. This change, which was to apply to 2022 transactions, was delayed and now applies to transactions that occur beginning January 1st, 2023. Now, since earned income is taxable regardless of the method of payment, the new reporting requirements may seem to be relatively insignificant. I mean, what could possibly go wrong? While it's intended to crack down on people that have side hustles, not those sending money to kids or a friend, some fear that the IRS isn't going to know the difference. According to a December 7th, 2022 article in the Daily Mail by Ronnie Reyes, taxpayers who have total transactions of over 600 are going to receive a 1099-K form from each of the third-party payment companies through which they receive the payments. The article quotes Republicans on the House Ways and Means Committee condemning the change. They wrote, "If you sold a couch, resold tickets at the price you paid, or just did some extra work on the side, you could trigger greater scrutiny from the Internal Revenue Service." Now, any extra work on the side is, of course, already taxable. The concerns are that individuals who receive cash outside of business transactions could inadvertently receive a 1099-K. It will then be your job to carefully examine any 1099-K you receive to be sure that the income being reported to the IRS is actually earned income or profits subject to taxation. Otherwise, you may end up paying taxes on income that's truly not taxable. Anyone who believes that they received the form in error is encouraged to contact the payment company for a correction. However, this adds a whole new layer of cost, complexity, and frustration around trying to correct a wrongly received form. And I think you've probably been there and done that. It can be quite annoying and time-consuming. Tax experts have raised concerns that the IRS just isn't equipped to handle the estimated 20 million new 1099-K forms expected when the rule takes effect. The agency already faces big delays during tax season. Several lawmakers have introduced bipartisan legislation to reverse the change. There's one proposal in both the House and the Senate called the Cut Red Tape for Online Sales Act, which seeks to raise 1099-K reporting to $5,000 instead of $600. Others are submitting proposals to revert the reporting threshold back to the previous $20,000 and 200 transactions. One is called the Saving Gig Economy Taxpayer Act, and another is Stop the Nosy Obsession with Online Payments. It's Snoop for short, the Snoop Act. Well, until the issue is settled, you may want to limit your transactions on these sites. If you can use a credit card, a check, or cash instead. Thanks for listening.